Hello guys, what is happening? Welcome to tonight's live stream. So we're going to be going through the inflation data that has been released. Inflation has rocketed now in the United States to 17%, and you can bet your bottom dollar that the inflation rate here in Canada is probably above that. So the inflation rate has skyrocketed. I know there will be a few trolls that watch this video that will be going, Luke, what are you talking about? The inflation rate is only 8.5%. Have you lost your mind completely? Well, we're going to go through that so you can see what the real more accurate inflation rate is as measured by the CPI, just not the CPI-U, which is being used right now, which is just bogus and completely not accurate at all. So anyway, we're going to be digging into this. This is big news. There is a lot going on with this inflation. So we're going to jump right into it right now. So I'm going to pull up this article here from Yahoo Finance, which basically explains it a little bit and breaks it down for us. So inflation rises by the most since 1981 as CPI jumps to 8.5%. Now, we'll get into the real rate, which, well, I say the real rate, but the rate that is more accurate than this 8.5% number right here, which is 17%. And we're really going to get into the wages because that is what I really want you to think about. And then we'll get into why the CPI-U and this number, this 8.5% that you're seeing here, doesn't really matter. Like, it doesn't really matter at all because, yeah, they can pull a number out of a hat and say, hey, the inflation rate's 3%. It doesn't matter because if the inflation rate is really 20% in the real economy, that's what people are actually losing. So the number that the government puts out, which is totally fake, just doesn't really matter. They do make it up. I say they could make it up. They do make it up, definitely. So D-Man just found this channel. Great, you're in Calgary. It's nice to have somebody from Calgary. I got a video that was filmed downtown going live tomorrow, so definitely check that out. But yeah, great to have some people here locally as well here in Calgary. Fantastic. Trent's in the house. David is in the house. Even at 8.5%, inflation is crazy. And as I've said before, the market cheers. Yeah. So we'll get into that. But let's just see what they're saying. The breakdown is of this. So U.S. consumer price increases quickened in March, underscoring ongoing inflationary pressures as supply chain disruptions and shortages lingered across the country. Okay, so why do we have these supply shortages? We have these supply shortages from the government's response to the cerveza sickness. That's what it really boils down to. The fact is, if the demand had just fallen and we'd just gone into a recession and they hadn't pumped all this artificial stimulus into the economy when people weren't working, then we wouldn't have had this excessive demand that happens. The thing is, sometimes you have to have supply and demand reset. You need these recessions in order for supply and demand to move in the right direction. Otherwise, you create these artificial stimulated markets, which is exactly what we've seen. And it was caused by the government's response to the cerveza sickness. Let's not forget that. Okay. I'm still suffering from jet lag. Forgive me. So the Bureau of Labor Statistics, the BLS or the BS, as George Gammon calls it, Consumer Price Index CPI rose 8.5% in March compared to the same month last year. According to the latest report released Tuesday, that marked the fastest rise since December 1981. And we got some interesting things that we're going to go through about that, but we're going to actually the 17% number that is titled in this video is using that 1980s CPI. So it's funny, isn't it? The fastest rise since 1981. But then we're going to compare using that 1980s CPI to what the actual number is today and what that looks like historically, how far we really are behind in what we're actually being told here. So that marked the fastest rise since December 1981. This followed a 7.9% annual increase in February. Heading into the report, consensus economists were looking for an 8.4% jump for March, according to Bloomberg data. On a month-over-month basis, prices rose 1.2% in March, following a 0.8% monthly rise in February. That's huge. Massive inflation. Some of the biggest contributors to the latest increase in inflation were food, shelter, and gasoline, aka energy. So isn't that funny, guys? The three things that literally, I edited a video today from England and I literally said these three things: food, shelter, and energy. They're the core of what we all need to live. And the fact is that those are the biggest contributors and they're excluded from the core inflation rate, which just is hilarious. But anyway, that it just goes to show how bogus the numbers really are when you really think about it. So anyway, according to the BLS, in fact, the index tracking gas prices surged to rise 18.3% month over month in March, comprising more than half of the total monthly increase in the CPI. In February, gasoline had posted a 6.6% monthly increase. Gasoline is a big component of what people have to pay to get to and from work. So it rising that much is a bad sign, as we saw in 2008 and many other examples of that. So it's, Luke, David says, Luke, remember to strip out food, energy, and housing. No one uses those things anymore. Yeah, exactly, David. Exactly. So even excluding the more volatile food and energy prices, the CPI also posted a marked move higher in March. The core CPI jumped 6.5% in March over last year, accelerating a 6.4% increase in February and representing the fastest increase since August 1982. A number of other major categories also contributed to the March increase in CPI. However, shelter prices rose 0.5% month on month in March and by 5% over last year, representing the biggest annual rise since May 1991. And we have to remember the shelter, the owner's equivalence rents are not accurate at all in shelter costs. I think it's going to be obviously way higher than that when we're talking about it. It also says, interestingly, that airline fares also soared by 10.7% on a monthly basis. That's insane, likely due to the release of different mandates and everything like that. And also the fact jet fuel has absolutely exploded in price and by nearly 24% over last year, as rising fuel costs and increased demand for travel pushed ticket prices higher. Now, something I just want to flag here real quick is this travel demand is going to be very short-lived. Like, we are going to see this sort of burst, I think maybe for this year, this summer, might even go as far as July, August. I personally don't think it will go that far because I think people are just going to have their backs so far up against the wall. They're not going to be able to afford to go on these vacations. So it's going to be very short-lived because obviously going on a holiday, going on a vacation, that's discretionary spending. And if people need to tighten their belts, they're going to cut away stuff like that. However, people have been locked up in a cage for the past 3 years. They want to leave. They want to go away somewhere. So I'm sure there are a lot of people that are happily going into debt just to get away and try and get some sort of mental health or whatever it is, just a break, just to relax, just to get rid of the burnout, whatever it is. So I'm sure that's going to happen, and that's going to kind of get the demand going. But even as we've seen, when we booked our flight to Cancun to go to the Riviera Maya in June, we basically booked that before all the mandates got lifted and everything like that. And we looked on the plane to see how many seats had been booked after on the seat map, and it was practically the same. So, and all the media and news outlets were saying, oh, everything, like the travel demand is absolutely insane. It's crazy, whatever. Well, we still managed to get a hell of a deal on plane tickets to Cabo for December. So the thing is, I'm just not seeing what we're being told in the media with a lot of different things as coming out with that. So Eric's in the house. Niagara Falls is pretty empty here. They are blaming the poor weather. What is the weather like there right now? It's got to be better than it is here in Calgary. I'm telling you that, because Eric, it is -10 here. It's snowing. Like, it was 21 degrees last Friday. Now it's -10. We literally rode in the bad weather, it seemed, on Sunday night. It was very windy. The landing was a bit all over the place, but it's always fun to have a roller coaster on the way in. Oliver St. John says, what does everybody think about XRP? You know, it's interesting. I own a very small amount. I want to be clear, very small amount of XRP, and I'm not a crypto buff or anything like that. It's such a small, tiny percentage of my portfolio. But XRP, I think, is just interesting. It's not something that I would put a large percentage of my portfolio in, but I do like what it's all about. And I mean, we could do videos on that, and I don't think people really want to see it, to be honest, with the current state of the crypto market. And I'm not a big crypto bull either, but I do think XRP could have a use in the future. But as I've said before, if you're considering buying crypto, you just need to be prepared to lose everything. It's kind of like almost like a gamble. And that's why it represents such a tiny portion of my portfolio anyway. And that's not financial advice, but each to their own. Like, I know a lot of people who have averaged into Bitcoin and stuff like that. And, you know, each to their own. I'm more bullish on gold and silver and physical metals as opposed to cryptocurrencies, which at the end of the day, there's just nothing really there. Like, what do you actually own? What's the underlying thing that you own when you own Bitcoin? But it's an interesting conversation anyways. So it was 5 Celsius for weeks. It's 15 Celsius today. Wow. So maybe we got the cold weather from over there. So that's interesting. Christchurch. So you're in where's Christchurch? In New Zealand? I thought that was in New Zealand. Let us know. Or is that in St. John? Anyways, so you can see here, consumer prices have been rising like crazy. You can see here on this chart that we are well into these 1980s numbers, and we'll get into that, because remember I said 17%, and here in 1980 inflation peaked out at 14.59%. Well, we'll get into that later. So it's very, very interesting. So basically we'll end that one here. So want to whip it over to Y charts so I can show you this. Basically, this is US average earnings year over year. So this is a chart. So it's currently sat at 5.56%. So if you subtract the 5.56% from the CPI number, which is 17%, you get real earnings down 11.44%. So the interesting thing that I want to highlight with this, and this is what I said at the start of this video, which I think is just so key that people take this away, because this is really like fundamentally what is really going to dictate where the economy goes moving forward. And that is that it doesn't matter if that inflation number the government is giving you is 5%, 10%, 1%, 2%, whatever it is, it really doesn't matter. Inflation is personal. It's different between me and you. So you have to calculate it for yourself. But in most cases, if you use a more accurate way of calculating it, like the 1980 CPI basket, then inflation's around 17%. So then if your wages just went up 5.56% and you also get taxed on that, so you're likely 4%, you're getting 4% or maybe even less if you're in a higher tax bracket, then you are deeply, deeply in the red. Like you are losing purchasing power so quickly. And that is a bad, bad sign, because obviously if people are paying more for food, they're paying more for energy, they're paying more for shelter. These three things, which we talked about at the start, the three things that are essentially the core of what we need. If those are the three things that are making up the massive increases that we have in inflation, that's a big problem, because people can't cut back. Well, they can, but it's going to lead to devastating circumstances. They can cut back on food. They can cut back on energy, of course, but only so much. And if they're paying so much more for that, like 20, 30%, let's say your electric bill went up or your natural gas bill went up 20, 30%, where are you finding that money? Well, that money is coming from your discretionary spending that you might have spent on a vacation, that you might have spent on going out to eat, that you might have spent on going to the mall and buying some things. You know, those different things are the things that get squeezed, and that pushes the economy into a recession. People start saying, honey, we're not going to do the kitchen because things are tight right now and everything's going up in costs. And the fact is, if you do the kitchen, you're going to realize that inflation has gone up substantially and you've lost significant amount of purchasing power. So then those contractors that do all the renovations and everything like that, they're losing work. This just has a compounding effect through the economy. It just creates the recession. And that is exactly what we're going to see, because wages are so far in the red. I mean, seriously, they are massively in the red. So it is very, very interesting, I think, that that is the case. But obviously, if we go to this inflation chart that I want to show you, which is on trading economics. Come on now. There we go. So I'm going to pull this up and I'm going to blow it up bigger so I can show you. So this basically shows you historically where inflation has been. This is really bad. I need to go one. There we go. That's better. So you can see, like, it dates back all the way to the 1940s, like to the 1920s, actually, is where it dates back to. And you can see that the inflation rate, it got up to 20% after the Second World War. Like, that's really when you saw these huge jumps in consumer prices. And what I want to highlight to you is you did get disinflation, where inflation went down. It didn't actually deflate and go negative. It actually went all the way down to zero and then went even higher. So consumer price inflation is volatile. It's very volatile. But the fact is, we are actually, so in 1980, the CPI was around 14.5%, which is right here, as you can see on this chart. And we are actually at 17%. So that puts us all the way back to here, which is in the Second World War, the highest inflation rate ever recorded, ever. And people just don't understand the significance of this at all. And they are just thinking, you know what, Luke, just give me that number of 8.5% because it sounds better. It's less painful to me. And then I don't have to deal with the consequences. So if you think about how much is rising, it's really just insane when you actually think about it. And you think about how much wages are going down, like over 10%. I mean, that's just insanity when you really think about it. So I just cannot believe that more people aren't talking about this. And obviously tomorrow we have the inflation, we have the inflation for the UK, which is going to be massive. And then we have the Bank of Canada that's coming out with its monetary policy report, which will be interesting. And also the long awaited rate hike, which analysts' consensus is 50 basis points. So like I said on Twitter today, if you don't follow me on Twitter, it's at Market Mania CA. And basically I said on there, 60% chance that they hike 50 basis points, 90% chance that they hike 25 basis points. That's pretty much the probabilities as I see them. So yeah, it will be interesting tomorrow because 50 basis points will knock the economy, but it will not be instantaneous like you can see it. And it could possibly knock real estate psychology just completely out of the water because the prime rates adjusted will be much higher. And what people don't understand about rates is the risk premium that a bank charges is based on your ability to pay back the loan, the risk of you defaulting on that loan. Now, if rates are going higher and you pick a variable rate and inflation is raging, the chances of you defaulting are higher. That's just the way it is, guys. That's just the way it is. If your wages are negative in real terms, inflation is going parabolic, and then you're also on a variable rate and you're in an interest rate environment where they're going up, then the chances of you defaulting on your payment are going up because your balance sheet is going like this and the bank knows it, and they're still going to lend you the money. They're just going to charge you more of a risk premium. They're going to lend you that money because they don't care. It's pretty much risk-free for them because the government of Canada is putting their AAA stamp on it. And even if it's uninsured mortgage, they're going to go and pay extra to get that insurance from the CMHC, which will eventually, these insured mortgages or subprime mortgages will cease to exist. And people who are putting like 5% down on a house right now, they're just committing suicide. They're committing financial suicide, essentially. And those people are just going to get wiped out. I mean, we literally just saw in Calgary prices drop 4% in a month. I mean, you figure you put 5% down and let's say you went over ask on a house, you're likely already underwater on your mortgage. What happens if prices then drop another 4-5% and then another 4-5% and then another 4-5%? Like, I'm just saying, like, it can get bad real fast when you put that little amount down. So people really just need to be exercising extreme caution in the real estate market if they're planning on gambling in there, because it really is a gamble if you're going in at this point. It really is. There's no other way of putting it. But we're going to mosey on over now to, and I don't plan to keep you guys on here too long tonight. We're not going to be doing like an hour length like we normally do, because we're coming on tomorrow as well with what happens with the Bank of Canada and the UK inflation. Everything like that, we'll be covering that tomorrow as well. So anyway, we're going to go over to ShadowStats now, which I love, by John Williams. And if we look at this is what gives you that breakdown, which we all want to see, which is the inflation rate as measured by the 1990s CPI and also the 1980 CPI. So what you can see right there is the CPI-U, which is the official CPI-U, which is this one, which is orange here. You can see it right there. That's the orange line. And then you can see the 1990s based CPI, which is the blue line. Now, what I want to first tell you is if you look at both those lines, they're highly correlated, aren't they? They both go up and down in the same way. But what is the difference? One is just vastly understating the rate. They're both doing the same thing. It's just the CPI-U is vastly understating that rate of inflation. There's so many different ways that happens. You can just look at YouTube. There are tons of videos explaining this. George Gammon actually did a couple of videos on this on Rebel Capitalist. So if you go to Rebel Capitalist and you look in his videos, or you just search Rebel Capitalist CPI, he explains it great in about 45 minutes, basically how this is just completely broken. He did it a couple of months ago and I thought it was fantastic. So check that out. But you can see if we use the 1990s based CPI, it's going off the chart for a start off, which I just find hilarious. You just look at this, it's actually going off the chart. And then if we go down, and this is published April 12th, 2022, that's today. And if we look at the 1980s based CPI, which again updated today, April 12th, 2022, you can say they've got the CPI-U again correlated exactly the same to the 1980s based CPI. But look at where the 1980s CPI is. It's at 17% up here. So it is just 3 points away from 20%. Now, with that in mind, if we go back to, so you can see right there, 1980 CPI, if we're measuring it using that 1980 CPI, it's at 17%. If we then go back to trading economics here, you can see that 17% puts us way above what it peaked out in 1980 using the same CPI basket as we're using right there to look at inflation today. So that being said, inflation is heading to the highest ever and the highest since after the Second World War. And this little tiddlywink down here, which just looks like, oh, it's just shooting up this little bit, it doesn't tell you half of the story. It's a bogus number. It's complete government fakery, just like GDP, just like unemployment, just like all of their bogus statistics. But what their statistics do show is change, and they do tell us somewhat of the story, even if it's vastly understating inflation or overstating full employment. They'll still do something in showing us some sort of trend of what's happening. And as you can see, if we go back to the ShadowStats, you can clearly see there that with that ShadowStats chart, the inflation is highly correlated. Like they look exactly the same almost. The peaks and troughs of where they've gone are exactly the same. So you can tell that they're measuring similar things. It's just this one, the corrupted one, is vastly understating it. And what's even more interesting, which I want to point out, guys, is where inflation has been historically over the past couple of years. Because if you look between 2015 and 2020, inflation was high. And if you also look around just after 2008, again, inflation was high. It was at 10, 11%. And when we supposedly got deflation and the CPI-U went negative here, it was still above 5%. So the fact is, we haven't seen inflation dip below 5% since 1987. So that just goes to show you, like, and that's real. Let's just think about that. That is real. Like, that's real talk. That's not this bogus baloney that the government is putting out. That's real talk. Like when we think about how much things have gone up in price over the time that we have lived, that makes total sense. But here's the thing: a lot of people will be sitting there and be going, well, that explains why real estate and stocks are the valuations are that high. But no, it doesn't, because their earnings haven't increased at the same rate for stocks, and people's pay hasn't increased at the same rate either. It's just been deeply negative across this whole period. So it's very interesting, isn't it, when you really think about it from a different perspective like that? Because really, I just don't even I see that 8.5% number and I just immediately think fake. That's really what it is. It's just a fake number. And then I think 1980 CPI, I'm going to check that out and see what it is. And it's likely going to be about 20% in Canada or something ridiculous like that. And I'm being honestly deadly serious. Like the CPI is probably around 20% real terms. So think about how that looks with your wages. Did you get a 20% rise this year? I doubt it. You'd be lucky if you got a 5% rise. So and a lot of people, the funny thing is, imagine you get a rise, let's say, of 10%, and this, and you're just like, I haven't even gained anything. I'm meant to be grateful for this 10% rise, and be grateful for it, because obviously you're getting a rise of something, and a lot of people won't be getting anything, so that's something. But you're still negative. You're still deeply negative, even with that huge of an increase. So you really, and this isn't financial advice, this is just myself and the way I think, you have to own something that is an insurance policy on your cash if you hold cash. And that, for me, is gold. And that's not financial advice to go and buy gold. It really isn't. The thing is, gold isn't something that you buy. It's not a get-rich-quick scheme. And everybody is looking for a get-rich-quick scheme. It's an insurance policy, like I said. Because let's say the recession happens and it's an inflationary recession, and the government comes in and they say, and this could happen, there's a chance that this will happen. If inflation is high and they, let's say the US isn't in a recession yet, Canada goes into recession. The government of Canada says, okay, we're going to start stimulating the economy. So then the Bank of Canada has to cut rates. That could mean the currency just goes into a doom spiral, which basically would look something like what happened in Russia, what happened in Turkey. And trust me, those aren't things that you want to have happen. Because if inflation is still going parabolic, then people won't want to own the currency. They won't want to buy the government's bonds. So they will be in a right predicament, because people will be trying to sell out of the currency, sell out of the bonds, because they're going to be deeply, deeply negative as opposed to inflation. So nobody's going to want to buy them, and it could collapse the entire currency. And that is personally why I hold gold, because I have zero faith in the government, the elected officials, the central planners and central bankers, and nobody should have any faith in these clowns. I was going to say idiots, but that's not really strictly true. But that they can be naive, but I'm sure some of them are actually decently smart people. It's just the way they've been educated is all messed up. But nevertheless, these clowns, you cannot rely on them. And I know a lot of people, and I really hope this sticks with a lot of people, but a lot of people have faith. They just have a little bit of faith in the system, even though they know it's completely broken beyond fixing. They at the back of their mind somewhere, they're thinking, I still just have a little faith in the government. And I've seen it in different comments on the YouTube channel and stuff like that, in people just taking these absurd risks, in my opinion. And it's just because of that. They think, oh yeah, the government will protect me. The government knows what they're doing. Like everything's going to be all right. Like recency bias, normalcy bias. And that's really what I want to put out in this video is, just re-examine what is your insurance. What is your insurance on your money? Be it United States dollars, be it Canadian dollars, be it Aussie, any of these fiat currencies that are Western, like, and so I would exclude currencies like the yen, the ruble from the equation. But these Western currencies, these fiat currencies, you need to have an insurance policy. And that's not financial advice. I'm not a financial advisor. That's my personal opinion and view. And with that being said, I want to show you what's happened with gold. And we're going to point out a couple of different things. I haven't done this before, but I thought, you know what? Yeah, Revert to Means is in the house, and he says gold and silver. Totally agree with you, buddy. So this is a chart of gold. So basically you've got spot gold here. And what I just want to show you is basically some of the supports and resistance that we have, some key levels that you want to be looking out for to see what the reaction is when they hit these numbers. So today I was actually posting on Twitter about this, that we actually went through a key area, which was this 1969, which it was actually like 1972. I just haven't got it that accurate on this chart because I haven't been bothered to go down to the smaller time frames and pinpoint exactly where it is. But it was around 1972, 1973, because I was trading gold today, so I know when the high hit and everything like that. And I was watching the reaction on the short time frame of what was really going on, and there was tons of buying, which is incredibly bullish at a resistance like that. To see that amount of buying taking place was bullish to me, a bullish signal. But what I find funny is, isn't it funny how it was like 1972 and the 1970s were like this period where gold exploded in price, and now it's hanging around the numbers, like all these numbers, like 1940 as a support. Well, that's where the highest inflation we ever had was. But these are your supports in yellow. So 1950, 1940, 1915. 1894, those are numbers to watch gold. If gold dips below 1940, it could be going lower down to 1915 and vice versa. It's not rocket science. And then you've got your resistances, which is 1970, 2006, and then 2052, which was the ultimate high. So those are your resistance. And as you can see, there's much more tight support down here for gold. So that means it's got more chance of going up from here because there's a lot more supports down here and they're tighter packed together. So that's going to force more upward pressure on gold, and it's rebounded nicely and formed a good trend since it hit this low down here at 1886. We've had a great bounce from there onwards. So those are your numbers on gold to watch again. So for the benefit of those listening, 2052, 2006, 1970, call it, are your resistance levels, and then your supports are 1950, 1940, 1915, 1894. So watch gold around those numbers. It's going to be incredibly interesting, I think, to see what happens with gold, because obviously gold exploded in the 1970s. And in fact, we can actually probably pull it up on this chart right now. So if we go to a month, I'm going to have to back this off. I don't know how far this historically goes, but we'll soon be able to tell. Does it go back to the 70s? No, it doesn't. Okay. So fair enough. We can't go back to there. So that doesn't work. But anyway, obviously gold exploded in the 1970s. So it's going to be incredibly interesting, guys, what happens with gold. And again, it's like I said, like gold is not a get rich quick scheme. It's just an insurance policy on your money. Like too many people, I think, look at gold as some sort of get rich quick scheme. Like, oh, if I just buy it, it's going to go to $1 million. I'll be a rich man and everything like that. You know, the funny thing is, if gold goes to $1 million, then that means stuff is going down. Like I was going to use profanity, but for the sake of losing audience on YouTube, I can't use profanity. And it's tough. You can hit the like button for that one because it is tough. But yeah, that's really the case, isn't it? When you really think about it. But anyway, guys, I'm just going to see what you're talking about here in the comments. So, anything interesting? Excellent year. Luke says Trent. No. People keep. I just watched a video. Trent says. I've lost that comment now. Here it is. Trent says, I watched a video out today from a realtor in Toronto. Says homes are down 100K, 200K, 300K in last month alone. Isn't that interesting? I would go to their videos and look what they were saying like 6 months before as well, where they sat there saying, hey, the prices are never going to go down. The inventory is low. The supply is low. I mean, God, we hear these things time and time again. I want to show you this tweet. Just going to bring it up real quick because this really showed it. Here we go. Because I thought this was fantastic. I mean, obviously, we've discussed supply on this channel like a bazillion times. But here we go. Rob Carrick, I'm not sure what that guy is. He's probably a journalist, let's face it. The supply myth brought to you by real estate industry trying to make extreme price gains sound reasonable. Could we please stop with the supply myth? And oh, look, it's the OECD average of number of homes per 1,000 people, which we've featured this statistic like 4 or 5 times on this channel in different videos. And still people go and comment and they say, there's no supply. We've got no supply. We're not building the homes. There's, you know, I just link the videos now. I don't even reply because it's just too much effort. But how many times have we been told in the past year that Canada's raging housing market is largely due to the fact we have the lowest supply of housing in the G7? Well, consider the attached chart from the budget sourced from the OECD, whose job it is to compare stats across major economies. First, Canada's supply is not particularly out of line with the OECD average and is certainly not much different than any of the UK, US, or Australia. And we have made the point many times that given a younger population than Europe or Japan, we would naturally have a lower ratio. Kids don't own homes. That's very true. Second, a technical point, Canada is in fact not lower than the US, so it isn't even the lowest in the G7. Yet somehow our average home prices are roughly 60% higher on average than in the US, with essentially the same level of supply per capita. Yes, we should do all we can to encourage supply, but clearly there is more at work here. BMO Capital Markets, this was released April 12th, 2022. You know, it's very, very interesting. And yeah, I think that's interesting. And there was a good article, which maybe we'll cover tomorrow, which was about how 40% of homeowners own like loads of the supply. I can't remember it totally, but we'll do the article next. So let's see what else we're saying. If Luke Jared, and Scott have been preaching this since last year. Two guys who were calling it so early. Yeah, that's true. We've been preaching it for a long while here. Scott Walters, Realtor Trent, is talking about on YouTube, and Revert to Means is who he's talking about on YouTube. Check them out. They've been, like he says, preaching the same thing as what I've been preaching here. And, no bias. That's what I want to put out there. I don't work in real estate. I'm not going to benefit if prices go down because I'm not going to buy here. And that's tax reasons. Like, I am not buying here, even if prices go down significantly. So I don't have that bias. Steve Suretsky is starting to crack. He admits Vancouver is turning and it's going to crash and burn. Steve Suretsky, he's just a journalist, to be totally honest with you, and really just an industry pumper, in my opinion. And he doesn't do much research, obviously, because he has said many, many times about that supply myth that we've got up on the screen right now. He's constantly, maybe I should retweet this at Steve Suretsky, because he needs to take a long, hard look at this, because he's been saying now for the past couple of years, supply is a problem, supply is the problem, supply is the problem. So, it's interesting. Steve Suretsky should come on this channel. I'm going to ask him. Yeah, you could ask him. I just don't know how well that interview would pan out. And I don't know if I could refrain from using profanity if he starts just touting utter BS. And obviously, to be totally honest with you, he's probably going to have a massive ego. And that's another reason that I don't want to have him on this channel, is because he's probably not going to take anything from a guy like me. So it would just end up being a pure argument between us, I would think. And I don't know, well, people would get some value from that. I'm sure it would be a great video to watch, but I don't know. Steve is Luke's buddy, eh? Yeah. Revert to Means journalist, yeah. So anyway, guys, I'm going to leave it right there. Thank you so much for watching. Please smashy on the like button if you haven't done so already. I know you guys have. Trent, David, Revert to Means, all you locals who are in here. Ed, let's do some shout outs. Who else we got in here? Oliver from St. John, Marco Pavic, David Sutton, D. Trent, Avatar Longi. I think I got that right. Maybe I didn't. Correct me if I'm wrong. Who else we got in here? We got Eric. We've also got also Oliver is from New Zealand. Interesting. That's great that we're getting a lot of people from New Zealand, because we need those people. We learn a lot from you guys, so please leave comments below of what's going on in your market and what you're seeing, because that's what we need to see. We get stronger by you commenting below, telling us the different stories, and then we can feature them in videos and live streams moving forward. And if I know I got a bunch of people who want to come on and talk as well, and we'll have those on in due course. I got to go through my emails. And D-Man, who just found the channel and is also in Calgary by the looks of it. So check out the video that goes live tomorrow. I'll see you in the next one, guys. Smashy. Peace. Bye-bye.